Welcome to TLD Talks, where we share insights about key legal and business matters that are impacting SMEs today. Bringing together experts from a range of backgrounds, we will be tackling the issues that matter to you. I'm Ed Simpson, CEO of the Legal Director, and I'm joined on today's podcast by one of TLD's very experienced lawyers, Anne Whalley.
Hi Ed, thanks for having me on the podcast.
And Rob Garner of Garwood Solutions. And we're going to be discussing how to prepare a business for fundraising. By the end of the podcast, you'll have a good understanding of how to get your business in the best shape to be attractive to investors and get the best valuation. So welcome, Anne and Rob. Rob, could I ask you to introduce yourself and the work of Garwood Solutions?
Thanks, Ed. Yes, absolutely. So as Ed said, Rob Garner, a career in professional services and pertinent to this conversation, former KPMG partner, and have subsequently, as I've sort of stepped down from an executive career, now formed Garwood Solutions. We work with organisations to help them to accelerate growth, improve operational efficiency, and very pertinent to today's conversation, realise value. And through that, we work both buyer and supplier side in terms of advisory around M&A propositions within the professional services kind of market space.
Thanks, Rob. So let's dive into today's subject. And I'd like to start with talking about the key characteristics of an investment-ready business. So how do you go about making yourself attractive to an investor? What are investors looking for?
So I think it's a little trite in a way, but investors are often looking for organisations that have a combination of growth and profitability. Various numbers get bandied around in the market, but typically a 40 or a 50% are the kind of metrics that people talk about. And really what they're talking about there is a combination of your EBITDA percentage and your growth rate as a percentage. So this accounts for organisations that might be very high growth but low margin, organisations that are medium growth, good margin, or organisations that are low growth, high margin. Actually, those combinations, when you hit that kind of 40 or 50% aggregate, start to become much more attractive to buyers. Now, it's not an absolute, and it is a little bit of a rule of thumb in terms of way people look for successful organisations in an acquisition strategy. That is one of the key characteristics that people are looking for in terms of an organisation being sort of investable. Beyond that, I think then you start to look more broadly at the organisation's characteristics and certainly from a personal point of view, other than the key dynamics about what market, because sectors matter, what service lines, because service lines matter. You then start to look at actually how well is the organisation run and actually how well prepared are they for an event, whatever that event might be. And certainly from a Garwood perspective, we'll sort of look at what we would think of as being a sort of almost like a market readiness assessment, looking broadly at the organisation across 4 or 5 dimensions, and actually, if necessary, putting in improvement plans to address any deficiencies within those dimensions before we would seek to take a business to market. And I think, part of that is about actually you want to present the business in the best possible light. Even if you're hitting some of those nice growth and profitability dynamics, actually having a lead in where you actually prepare that business for market and have a performance improvement plan is, in our opinion, key to maximising the value of that business in the market when you do take it to market.
Yeah, I mean, I would say that getting some clean accounts, having a history of achieving budget and having a sensible business plan going forwards are fairly key. And I think another important factor is to get the right advisors on board who really understand your business. It's a bit like appointing an estate agent to sell your house. If you've got, one valuation that's way higher than the others, you have to question why that is and whether that's realistic. Should you be valuing on a revenue multiple or an EBITDA multiple? It can be as basic as that.
I think, Anne, I'd also kind of emphasise in that clean accounts, achievable budget, all of those sorts of things. Actually, they're very specific instances of having great MI. Actually, the management information that's available with clarity and timeliness is a big confidence booster to any prospective buyer.
Yeah, and part of that is obviously getting your data room set up. So you've
Absolutely.
got all of your information in one place. You know, your documents are all signed, they're up to date. And one of the factors on that is, are you going to have multiple parties looking at it? You might want a more sophisticated data room whereby you can disclose certain parts of the data room to some parties and not others. For example, trade buyers, you might want to hide some information from them in an early stage of a process. But certainly, yeah, getting everything in one place, which can be a very, very time-consuming exercise if you're not organised.
Okay, so we've started talking about management information and data rooms. Can we just talk a little bit about what sort of management information investors are going to want to see? And if you could also pick up and explain what a data room is, there may be some of our listeners who are not familiar with that term.
Yeah, I mean, in the old days, data rooms literally used to be a room that were filled with copies of all documents relating to the business. But I'm pleased to say that now they're all virtual. I think most of my clients will tend to use Dropbox because they're familiar with it and it's relatively cheap. On bigger deals, I've used more expensive data room providers, they're quite sophisticated in that you can do your Q&A through them and, you know, they capture everything in one place. But essentially your data room is getting all the information about the company in one place so that you can give access to third parties to review that information. When I'm starting a process with a client, I will tend to send them a data room structure and or a DD questionnaire so they can structure their data room in an easy to follow way. And you can obviously expect to be adding documents throughout the process.
So you mentioned there all of the information about the business. Are there any limits to what an investor might reasonably ask for?
The answer to that is no. I mean, I would start off with, you know, what are the investors buying? So for a tech company, you're looking at the IT, obviously, and the IP ownership. So you're going to be focusing on how the IP is being developed. If it's employment contracts, is the IP all vested in the company? If it's consultants, have they signed all the IP? Key contracts that obviously are a key part of the value of the business. Are there change of control clauses? Can we get rid of them? Are key contracts about to expire? Do they need extending? So these are all things that you can do in the preparation stage for getting ready for an exit or a fundraising.
I broadly group the information that goes into a data room in two categories. I think you've got a category which is about trading, past and future, and you've got a category which is about assets. And I think, you know, assets can go on and on and on, can't they? Because they can be physical, they can be logical, they can be IP, they can be intangible, they can be people. Broadly, DD and the data room there to service DD is helping you to answer those questions about past and future trading, projections and forecasts, and also the assets of the organisation.
It's perhaps important to make the distinction between what the investor will be wanting to see and what the lawyers will want to see.
Absolutely.
And they're not always aligned. Lawyers get very excited about GDPR, which is incredibly relevant to some businesses and less so to others. But there are some things which clients will groan when I say, but things like statutory books, they may sound insignificant, but ultimately they prove the shareholders' ownership of the company. It's critical to track them down initially and make sure they are up to date because that will hold up deals.
You make a really good point there that actually, you know, what you're going to need earlier in the process tends to be those parts that are going to satisfy an investor. What you're then going to need as the process naturally moves forward and perhaps you're more into kind of deal completion, deal execution, then you're going to need all of those other assets, which, dare I say, the lawyers get more excited about. However, the best deals have all of that information available at the outset, but there are definitely different communities that will look at different parts of it at different times in the process.
Yeah, agreed. And also getting organised at the start of a process will inevitably save time and cost because otherwise you are paying lawyers, for example, to ask questions or ask for signed copies of documents. You're then paying probably double lawyers to ask for a particular document.
I can imagine that there will be some business owners listening and thinking, you know, I don't know where all my contracts are, or I've no idea where my company books are or whether they even exist. So are these things that can be fixed? And are there any issues that, if they can't be fixed, are going to be so detrimental that it's going to kill your deal or make you uninvestable?
I think most things can be fixed. I mean, if you're talking about company books, they can be updated, ditto with your tax filings. I think possibly the ones where you are dependent on your third parties, might be more problematic if you're wanting to remove, for example, a change of control clause from your key contract. Possibly that's more problematic. However, if it's a good relationship, if the pricing's working for both parties, it's always an option to go to that party and ask for a waiver or a removal of that clause. Perhaps confidentially talk to them about what you're doing and would that be acceptable to them, and get something in writing that you can then pass on to the investor. The ones that are more problematic are where share schemes, which can be a minefield, are being set up incorrectly. And they can be quite time consuming to go back if you've missed out at getting valuations or serving the right notices. But I think I'm a great believer in that anything can be corrected. It's really about its time and cost.
I'd absolutely agree, Anne. I mean, I think probably my only other addition to it would be to say, yes, it is time and cost. It's also a little bit of confidence in the buyer.
Yeah.
And that can then, their confidence can be a little bit undermined. That might come through in terms of, a little bit of chipping in terms of sort of deal value, deal structure. I'm not saying that would be deliberate, but it's certainly not building the confidence of the buyer that this is a well-run, under control asset that they're acquiring. It's much better to resolve them, as you say, upfront, get a clean statutory register or whatever it happens to be, tidy all that up early, even though it might not be required until very late in the process as part of a legal DD. Better to do it then than be trying to tidy it up in parallel with that DD, or only discovering you've got a problem because actually the buyer's lawyers spot it and tell you. I have never come across anything that's insurmountable. What I have come across is situations where it undermines confidence and chips at value, basically.
Yeah, I agree. And actually, the slickest process I've ever been involved with, we prepped for about 6 months, and the company was so organised, management was so impressive, they were all over it. At the end of the day, the private equity house actually said, right, we don't want any warranties from management. It's the only thing we've done. But they were so confident and, they wanted the business. That was rare, but a fantastic result.
Yeah.
And that was all about preparation.
So I'm hearing the key takeaway is to approach your preparation phase very much with the mindset of the buyer or the investor, and
Indeed.
think about what they might see as problematic and address those up front so that you can give a nice, clean picture.
I think what we've been talking about for the last few minutes sits in the sort of tactical aspects of what you need to do to prepare for the business as a sort of market engagement exercise. I think we would also, in that kind of market readiness, also look at issues to do with, say, organisational leadership. Actually, are there roles that need to be filled in the leadership team to take this to market in a more confident and confidence building way? I can think of a scenario where actually we brought in a sort of interim FD, because actually that interim FD was just able to add a layer of almost professional presentation that the management team didn't have themselves. We'd also might look at things to do with the kind of go-to-market strategy. So how are things being taken? Is there something that we need to do with sales? As Garwood, we're big advocates of professional service automation solutions. So actually, how are you controlling your delivery? In a professional services context, you're not leaving money on the table, you're not leaving margin on the table, you manage scope tightly, all of those sorts of things. So I think we see that kind of market readiness assessment. Are there things that can be done in an operational context to prepare the business to take it to market, as well as are there a whole series of things that are almost market engagement specific that can be done, like having a fantastic data room set up and fully populated before you ever engage with the market. And I think that for us is key as part of that preparation phase.
Yeah, and I agree, Rob. Getting an interim or permanent CFO in, or finance director can be really key to get the accounts clean, which we talked about earlier, and also to just manage a lot of the initial DD that's going to come in so that management have got time to do their piece, because it can be massively time consuming, managing that financial DD exercise. A lot of smaller businesses in particular, they'll have a financial controller, but they don't necessarily have the right expertise and experience to manage a process.
So let's assume that we have done our readiness assessment. We've got ourselves ready. We've got all our due diligence data ready. We think we're ready to go out to the market. What happens next? I mean, I'm sure listeners will have heard of things like teaser documents, investment memorandums. How do you actually get yourself out there?
So I think there's a step, Ed, between, maybe it is part of the prepping the business, but actually there is also a market assessment element to be done. Where are we going to market this business and through what channels? And actually are we taking this business out for private equity style investment and buyout? Are we taking this business out as a trade sale? If we're taking it out as a trade sale, what do we think the type of buyer might look like? What are their characteristics? That, for me, would influence a little bit of how we prepare the business to take it to market. It would influence a little bit of how we put those documents together that you describe, a kind of teaser and an IM, and literally, in my opinion, have a kind of long list of prospective targets. Even if they're not named as organisations, at least named as sectors with sectoral characteristics that we're going to market the business to, that would guide the way that I would put those documents together, as you described. And, for me, a teaser is a 1-2 page document with some very high level information about the organisation. It's almost the shop window document. Get that teaser out and get people to engage. Once people have engaged, the next key document, I think, is that other document that you described, whether you call it a pitch deck, people call it an investment deck. I would tend to call it an information memorandum. It's all the same thing. It's a 15-20 page document that goes into more detail, a lot more detail than your teaser, but is far from the level of information that anybody would ever require to actually do a deal. But it is the vehicle for a discussion.
Yeah, just picking up on one point, you mentioned NDAs there. Very key to before you send information out, which particularly the IM can be, quite sensitive. I always try and just get a very sensible, balanced NDA that the client can use and send out, because, you can spend a lot of time and, again, money negotiating NDAs if you start off with something really aggressive. And so I think it's really key just to get an NDA, which is pretty much non-negotiable. The other thing I just mentioned is bear in mind, obviously, that there will be some trade buyers having a look or fishing. So again, that needs to be borne in mind. What information are you wanting to disclose and is needed to be disclosed at this stage?
Actually, the other thing we haven't said is that I would often write a teaser that's anonymous. The teaser may well be a 2-page anonymous document that describes the organisation but doesn't name it or doesn't provide enough information that it's identifiable. The information memorandum subject to NDA is then a very identifiable document and is providing that next level of information, about the organisation.
Is that normal then, Rob? I've never heard of an anonymous teaser, actually. Is that...
We've done that on more than one occasion. Because some of the information is very sensitive, what you don't want people doing is necessarily running off and starting to run their own kind of ruler over the organisation from public domain sources. I've actually had it the other way around, where actually I was on the sell side and we actually had a kind of teaser from a buyer through a buyer's advisor. That was completely anonymous. We didn't actually know who the buyer was going to be.
No inkling at all.
But we had no idea at that stage who that potential acquirer was going to be. We then signed an NDA through their intermediary. And then at that point, we were provided with more information, including obviously the identity of that organisation. But it is certainly something that I've come across both buy and sell side.
The other point I would want people to be aware of here is about who you can share your information memorandum with and your teaser document. There are some pretty complicated rules around what's called financial promotions. So where you are marketing investments, there are a number of defined categories of people that you can share things like that with: sophisticated investors, high net worth individuals, etc. But if you get it wrong, the consequences can be quite dire for you. So it's absolutely worth getting good advice at this stage as to who you should be sharing your IM with, and more particularly who you shouldn't, and the ways that you can and cannot share that IM. Let's jump forward again in the process. Our information memorandum has gone out to a number of potentially interested parties. You might have one or two people who are showing serious interest. What happens next?
I think first thing to say is there is no one process, Ed. Every deal that I've been involved in has probably followed variations on a theme, but a subtly different kind of path. Typically, if you're getting into an engaged conversation, at some point, someone is going to start talking about wanting that conversation to be exclusive. That's perfectly normal and acceptable. I personally like to run a process that gets us to a heads of terms and an offer relatively quickly in the process. If someone's at the point of kind of wanting to go exclusive, indicating that they're going to make an offer, I would offer a window of sort of limited due diligence. Typically, your information memorandum is not going to have enough information in it for them to actually formulate an offer. I would typically open a short window with a limited amount of information for them to do some quick due diligence that would allow them to get to offer with enough detail, subject to that offer then being acceptable, extending that exclusive period and entering a full due diligence. But there is a little bit of chicken and egg in all of that. Yet sometimes you might get an offer and the offer letter is very scant. Sometimes you'll get a quite detailed offer.
On that, Rob, I think it's, from what I'm seeing, it's increasingly common for the offer letters to have, schedules of lever provisions, all sorts of provisions that you'd expect to see in a shareholder agreement or articles. And I think it's really key to get some advice on those provisions. Once the documents are in circulation, you're pretty much locked in to those kinds of terms. And it's really difficult to negotiate away from them once they've been signed. And also, the terms of the exclusivity, there's some sneaky drafting out there. You need to be careful what you're signing up to, because you can get caught out by that. The other thing to watch out for is that often investors will try and put you on risk on costs, or that you are ultimately responsible once the deal completes. But abortive fees, again, I'm seeing much more of that. They're looking to the company to pick those up. That's something that needs looking at really carefully so you know what you're budgeting for.
I agree with Anne that actually increasingly we're seeing quite detailed offers, well, short of contract, but quite detailed offers. It's then around that offer that you as the seller are potentially, or then entering a negotiation period. Typically at that point, it's slightly more around the commercial terms of the deal. Once that is an agreed commercial form and it's an acceptable offer and heads of terms are effectively signed, then you are moving into a longer exclusive period and a much deeper commitment in terms of due diligence. You've gone from something that you might measure in weeks to get you to offer to something you're probably going to measure in months that gets you from offer to completion or closure.
And one thing it's just worth mentioning there is the time commitment for management in working through that process. Management are full-time working for the business. This can become a full-time role. So it's a very fine balance with keeping the business moving, wanting to continue to sign deals, bringing the investor good news, and keeping the process moving. It's a very, very fine balance.
So we've talked about abortive fees, which obviously suggests that not all deals, when they've got to this stage, get over the line. Can you give some examples of why deals fail and the point in the process when that is more or less likely to happen?
If there are nasties in the accounts, it tends to come out quite early, and that might be a black hole in a pension plan or something fundamental like that. More commonly in the deals I've worked on, it is later on, and it's a combination of deal fatigue. The private equity, their fund will be full or things just drag on. But commonly it is the shareholders or owners. What can start off as a crack in the relationship or expectations becomes a chasm during the process, and their interests just become irreconcilable. It can be valuation, it can be a multitude of things, but it is often the management team that just disintegrates and becomes dysfunctional during a process.
I wouldn't disagree with that at all, Anne. I think what I would say is that, in my experience, if you took it all the way back to first conversations around an IM and measured it from that, most deals don't complete. The majority do not get through that process, whether it's relatively early because you can't actually agree a valuation and a price and the commercial construct is just not there to do a deal. I've had a number fail on that basis in the past. I agree with you, Anne, that probably, if I thought hard about it, most deals that fail beyond that failure to get a kind of basic commercial deal construct tend to fail on the seller's side of the equation.
On the smaller deals, I find I can act as a part counsellor and I am trying to keep the deal together. Part of that is, for many, it is a totally new process and they just don't understand, for example, that the investor might want to lock them into the business for 2 years or, that they can't go off and set up a competing business if they do leave. And it is an education process. And with some, there is great resistance to any form of restriction when they've been running a business for 10 years and set it up.
What we haven't said in this conversation is that actually, certainly in smaller deals, this is as much an emotional process as it is a functional technical process, particularly as a sort of owner-managed seller. As you put out, Anne, there's a sort of education journey. But with that education journey, there's also a bit of an emotional roller coaster that you're going to be on, particularly people that have been owner managers for some time. Maybe their business has been a bit more of a lifestyle business. They knew they were going to sell it one day. I mean, very different to my own experiences where I set up my business as an asset to sell. That was still an emotional process when we came to sell it, but it was slightly less emotional than someone that had been running a business for 20, 25, 30 years and hadn't really thought until very recently that they might sell it. That, as you say, if it's a single seller, that has one dimension to it. If it's multiple shareholders, it's often those aspects that open up those kind of cracks and chasms between the shareholders that, from a sell side perspective, cause the deal to fail.
It's a sort of combination of recognising that the business needs investment and yet resenting that you're having to hand over any form of control.
Indeed.
Reconciling the two is really hard.
And this whole discussion about kind of control and the fact that actually even someone that's looking to make an investment that might equate to 10, 15, 20% of the equity holding would have quite significant control levers built in through restrictions, built in through potentially kind of veto rights.
That came up on a deal I was working on last year, and it's very difficult to explain why an investor coming in as a minority shareholder will take the same restrictions as if they're a majority shareholder.
Absolutely.
Really interesting. I'd like to draw things to a conclusion and have a quick discussion about what the market is like at the moment. There's been quite a lot of press in the last year or so about how much money is out there, that venture capital firms have been very successful raising new funds and they've got beyond all this cash, which is looking for a home. Are you, as an advisor working with SMEs, are you seeing any impact from this?
No, definitely. I think certainly within professional services, the last 12 months has seen exceptional levels of activity and people that track deal volumes. So for argument's sake, people like Equitech would say that probably transaction volumes are at record levels and are probably up somewhere around 20% on pre-pandemic levels. 2021 as a calendar year was a very buoyant year for the sort of volume of deals being done. But what's attractive in the market at the moment and what are people buying? I think you can look at it in kind of organizational features and factors, and I'd look at it in kind of priority market areas. So priority market areas for me in terms of professional services, financial services and health have been the two big market drivers as areas that have seen the greatest activity. Based on what I've read, those two markets probably account for something like 60% of the deals that happened in 2021. And I think if you look at kind of factors or trends that sit within that, you've got digital writ large, which I appreciate in some instances isn't isn't a factor, isn't a feature. But I think the thing that is a factor and a feature is organisations are looking for companies that are best tech enabled to deliver their services. And how are you using tech intelligently, not just to cut cost, but to actually improve kind of customer client experience in terms of engagement? I think that's one area. I think the other area that we've seen in the last 12 months that's gathered momentum is the whole kind of ESG agenda. And I don't mean in terms of actually seeing it as a market that they want to invest in as a market, actually having ESG as part of their evaluation criteria and their selection criteria in a way that I suggest a few years ago, pre-pandemic, we wouldn't have seen.
Interesting. Thank you. And if I could finish with another buzzword that I'm sure a lot of listeners will have heard of and maybe know something about, which is crowdfunding. And to what extent is crowdfunding making a difference in the marketplace for investment? Could it be the answer for some of our listeners who are looking to raise money? How do you see the sort of recent crowdfunding boom?
You would have to say it is a vehicle within the market that may be suitable for certain people that are listening. Absolutely. I would just caveat the sort of crowdfunding market with 2 points, really. One of which is that actually, if you're going to crowdfund, you do need prior commitment to a sizable chunk of your investment raise prior to launching it on a crowdfunding site or through a crowdfunding vehicle. Typically you need pre-commitment of 30 or 40% of whatever your raise wants to be. And the other point I'd make is that crowdfunding potentially is a quite expensive source of money. Slightly more traditional debt funding might be a cheaper source for you. Other sources of equity funding might be a cheaper source for you, angel investment networks and things like that. Crowdfunding has clearly got its place. It's had a lot of press recently. It has created a new market and it will definitely be suitable for some people that are listening. I just caution that it isn't a panacea, in my opinion. And actually, you do need to go to it with a fairly healthy level of what one might think of as being traditional angel or seed investment pre-committed before you enter a crowdfunding scenario.
That's great. Thank you. Well, that brings us to the end of our discussion, to the end of the podcast today. Thank you, everybody, for listening. And thank you, Anne and Rob, for participating. If you enjoyed our discussion today, you can subscribe to our monthly TLD talks covering a wide range of legal and management topics. You'll find details on our website, thelegaldirector.co.uk, and you can also find us on Apple, Spotify and Google. If you'd like to know more about preparing your business for investment or the wider work of the Legal Director, then do give us a call on 020 3053 8613 or visit our website.